We are joined today by Bill Spizman of McGladrey, Dan O'Connell of Vestar Capital Partners, and Joan McCabe of Brynwood Partners. Welcome. Thank you for joining Privcap today.
Thank you.
We're talking all about the private equity opportunity in the food sector. All of you are very active in the food sector and have great stories to share about value add and the ability of private equity firms, your firms and your clients, to transform the operations and the fortunes of some of these companies and really position them for a very profitable exit. Why don't we start with a couple of stories from Dan and then Joan. Dan, your firm Vestar is known for a number of high-profile deals, but one is Birdseye, the packaged foods company. Can you tell us about how that opportunity came up, what your thesis was, and you know, how you've worked with the management of that company to improve it and you know, turn it into a better, more valuable company?
Sure. Birdseye was a tremendously fun deal, but it didn't actually start out that way. It was actually, we had a tough couple of years when we first invested, but it was actually a company was called AgriLink, and it was controlled by the largest farmers co-op in the U.S. called ProFac. They had acquired Birdseye because they wanted a vehicle to sell more vegetables under the Birdseye name. But they had probably paid a little bit too much for it, and they borrowed all the money, so they had gotten themselves a little over leveraged. And so they hired a banker to help them raise about $175 million to fix their balance sheet, and they wanted to bring in a firm that could add had done things in the food space, in the consumer packaged goods space, and they met with a number of firms, and we ultimately you know, succeeded at that. And but we were 50-50 investors with the farmers, and we had control of the board, but they had substantial participation. And our strategy initially, based on a consulting firm we had hired to help us do the deal, was to really, they did both private label and branded. And the frozen vegetable category was basically a flat, mundane category. Branded was in a gradual decline. Private label was increasing. Not a lot of value added, not a lot of innovation in the category. So our strategy initially was to really ride the private label side and hopefully have that provide leverage with the big retailers. So we went on that path for the first 18 months, 2 years, and our EBITDA went from about 120, 125 to about 80 million. So we were not doing very well. So, but luckily, one of our longtime consultants and someone who had focused on the food industry, a guy named Kevin Mundt, joined our firm 2 years into the deal. We asked him to go on the board, and he came to his first board meeting and he said, "We're going to sample every product at lunchtime. How about that? Let's go get, we had a kitchen near the boardroom, so we all sampled it, and we said, we got a quality problem here." So we began to improve the quality, and then Kevin's suggestion, and this is an example of private equity value add. He was a student of the food business, but particularly frozen and refrigerated, had done some work for some firms over in Europe, and he knew that frozen and refrigerated was a more developed category over there for whatever reason. And so he hired a specialized consulting firm, and with the management team trekked over to Europe and met with, you know, the Birdseye of Europe and other manufacturers over there, most of the retailers, and came back with the idea of a steam platform in a bag and steamed vegetables, which initially we thought would be more taste and quality and freshness. But convenience was the hidden jewel in there. So came back and we developed the product over a 6-9 month period. We locked up the packaging for the U.S. Only could do it for 3 years. That's all we could negotiate. But it gave us a lead over the competition, and that became groundbreaking or disruptive technology in a sense in the food space. And but what we learned over a couple of years is that convenience was more important, or as important as freshness and quality and taste, that type of thing. And then our CEO, Neil Harrison, did a fantastic job, had joined us from Heinz. He developed a whole sonar map in terms of where he could take the steam platform in terms of adding starches to the vegetables, and then ultimately meals and then snacks, whatever. And but it was really a wonderful transaction. But the key thing there for us, the learning for us, was innovation. That when you invest in a legacy brand that maybe has real brand equity, you need to have not just one innovation, but a whole series of them too, because they very quickly get copied by the competition. So that was the story.
And of course, I'm going to imagine you had to put a significant investment of time and capital into developing the steaming innovation.
Oh, sure. Yeah, probably to develop the product was, 25 to 50 million. And the key thing was supporting it with advertising. So we grew the EBITDA from when we first launched it, probably 80 million to about 140, 150 million. But our advertising budget had gone from probably 6 to 10 million in the year we launched up to about 50 million. So from a pre-marketing standpoint, the EBITDA, was up 2.5 times. But that was, and we'd have constant debates at board meetings about when Green Giant was going to launch their competitive product and when private label was going to start copying us. And we had what we called our Defend Steam Fresh Kitty. And in some years it would mean that we would perhaps do, 5%, 10% less EBITDA, but we felt that we were building for the long term. So.
It's fascinating that you were able to find that disruptive technology. That's, I think, that what's interesting. That I probably would have made the mistake of saying go with private label because that's what conventionally
we did do that. It wasn't working. Now,
I would have done the same thing.
Yeah. But what's interesting, we did get hit by the lightning stick a little bit, but it was my partner Kevin Munt who had the idea, who had a global perspective in terms of innovation around the world.
Right.
And he was aware of the fact that this was that there was more innovation in this category, and it was a growing category. By the way, when we ultimately, we filed to take the company public, ultimately Pinnacle bought it, and it was just a key part of Pinnacle's IPO, which was very successful. But the dynamics in the category changed dramatically. All of a sudden, frozen vegetables became really on trend in that 2002 to 2009 period when we owned it. It became really an on-trend category. It began to grow 3, 4, 5% rate, and branded began to really pick up share. Private label probably got to 40, 45% of the category when we, a couple years into the investment. By the time we exited, private label was down into the 30s, and branded was growing. But it is, you don't find that every day. It's unique, and you're always searching for those in your next deal. But
innovation is, though, a critical element of growth.
Absolutely.
Because you just can't hammer on the old product to continue to provide the growth. Innovation will provide that. And I think prepared meals, there's a trend for prepared meals. There's also the trend for private label. But there's more profit in the trend for prepared meals than it is. The price point isn't as sensitive because the labor, someone is looking at that versus going out to a fast food restaurant that's much healthier, where the fast food restaurant isn't healthy, probably more price competitive, and private label is not an option, for them. So,
Joan, can you tell us about an experience that your firm Brynwood had with a candy company?
Yes, as I said, we generally like to buy corporate orphans, corporate brands that are being disposed by larger companies. And we currently have a candy business called Demet's Candy, and it's comprised of 4 brands that we purchased from Nestle. We bought the Turtles brand. Interesting in that situation because
Is that a candy bar?
It's now a candy bar, but when you talk about innovation, it was originally, at the time we bought it, just really boxed chocolates, very small, a corporate orphan for Nestle. We bought only the U.S. business. They kept the Canadian business, and it was a business that was burdened with a unionized plant that was operating at 15% of capacity in Canada. And so we agreed to buy the U.S. business, take over the plant in Canada, the union, and oh, by the way, close that plant. We built a greenfield facility at the cost of $13 million to us on a purchase price that wasn't a lot larger than that, so invested heavy in the business to innovate. And we took it from what was essentially a box seasonal chocolate business to everyday 99-cent bars. As Bill said, imitation is the highest form of flattery. Our form of innovation is less groundbreaking and more just giving the consumer what they want, stand-up boxes that maybe you can open up and have only 6 turtles in them. So we went to Costco and we found you would like this, David, macadamia nut cluster. So the Costco,
Hawaii, that's good.
yeah,
Yes.
and you know, when you are a fairly small business, getting a $20 million from Costco, an order from Costco for $20 million can really augment the throughput of the facility, add jobs to the business, and add to the profitability. So the business at this time has 4 brands doing very well in our Greenfield facility, and from the time of investment, about $8 million of EBITDA to now about $35 million. And no rocket science, unlike the steamer's technology, but working with retailers and innovating for the consumer.
Joan, what are you doing from a management standpoint there?
We put in place a whole management. These were corporate orphans. We just bought the trademark. So we start with renting a facility, and then. But it's interesting. Our first business was Flips, which was about $25 million in sales and about $3 million of EBITDA, and then we put the Turtles business on top of it. We still have about 12 people in our corporate office. So there's a lot of operating leverage you can get in the lower middle market to grow these brands.
I was thinking, if you were an owner of a business and you got a $20 million contract from Costco, you would say, how am I going to staff up for that? How am I going to finance that? When you're a private equity firm and you're private equity backed, you can say, we clearly have the financing and equity to do $20 million of additional business. It's no problem. So it's kind of an advantage that you can bring to
Well,
the
that's
table.
a good point, Bill. We always say that we don't over leverage our businesses, because for small businesses, you do have large revolving credit needs, seasonal, working capital, and then the vicissitudes of small businesses. You can lose a $20 million order as easily as you can get it. So we never want to be in a situation where we're over levered and in default. So that is why for businesses our size, we need to get our gains from operating improvements, not deleveraging.
We have dedicated people within our transaction practice who work with private equity firms in buying middle market companies as well as helping them sell their middle market companies. We also have fully dedicated people working on the audit and tax side of the audits of the portfolio companies. And we also have specialists in our consulting business who work with IT and performance improvement. So we're well-rounded with respect to the services that we can provide private equity firms that are dedicated and committed to owning food and beverage companies. I'm approached on a regular basis by private equity firms that specialize in food and beverage or want to specialize in food and beverage about our expertise in buy-side due diligence, both on the IT, financial, tax, and performance improvement. Because of our expertise, we can help them identify various issues through the process. It's a distinct advantage for us because we can help a private equity firm buy the company and then through its ownership period to perform audit, tax, and consulting business, and then upon exit, we can help them through the exit process, whether it's focusing in on the quality of earnings or tax planning or working capital considerations that need to be considered upon exit.